So this bill is a reprise of the theme of making our corporate tax environment more competitive in the aftermath of the rollout of BEPS 2.0, which was debated last month in Parliament. I spoke on the joint debate on the M&E bill and associated income tax bill then, as did my Sengkang teammate Louis Chua. But I will offer some additional thoughts here. In particular, I'll speak about the nature of incentives for corporations, and more generally about the principle of effective taxes on businesses. The overarching economic objective of incentives offered via tax breaks is to encourage firms to expand their investments and scale up their operations. In Singapore, this is targeted at high value-added products and services, and the pathway begins with, initially, schemes such as the Pioneer Certificate Incentive or Startup Tax exemptions, which offer a tax holiday of 3 to 5 years. When this expires, it may be followed by the Development and Expansion Incentive, or DEI, which grants a concessionary tax rate of between 5 and 15%, at least today, based on earnings that exceed the average of the prior 3 years. Schemes such as these have allowed Singapore to keep its effective tax rates, or ETRs, relatively competitive. Now, the rates that companies actually pay, rather than what on the face they owe, of course, is different. And in the case of the statutory tax rate, it has been in place at the 17% rate since 2010. Businesses, on average, however, paid less than a third of that, 5.1% in that year, and an even lower 4.3% in 2019. Now, this need not be a bad thing, per se. Economists know that low taxes on capital promotes investment from both domestic and foreign sources, which in turn can drive growth. But it's worth reflecting a little on why we accept this trade-off. After all, we do not willy-nilly grant tax relief to income on labor or land, believing that workers and landowners, rich and poor, should pay their fair share, at least in paying for the public goods that we all enjoy. Here, at least, we must be convinced that such tax reliefs generate benefits of additional investment that will lead to new jobs, or create new competitive industries, or yield greater opportunities for other companies that exceed the cost of the foregone tax revenue, which could have been directed to myriad other purposes. Whether these tax rates do so, however, is far from established. To be fair, the government does require that a certain number of jobs be created as qualifying conditions for these schemes. But it is not known whether these jobs would have been created anyway. Nor do we know if, in the absence of these incentives, there may have been some gaming of the criteria with temporary or ghost positions created to meet the conditions only to be extinguished thereafter. I would be curious to know if MTI, or MOF for that matter, has ever conducted rigorous studies that show how low ETRs are causally linked to job creation or spillover effects, and if so, if they would be willing to share them with this House and the public. So, regardless of what one thinks about the efficacy of keeping effective taxes low, the reality is that the global rollout of BEPS 2.0 threatens to upend this comfortable arrangement, at least for larger corporates here. New legislation being passed around the world, such as our own M&E minimum tax bill, just passed last month, will now allow top-up taxes to be levied by other jurisdictions should they view our effective taxes as unjustifiably low. Now, the stipulations of BEPS, of course, only apply to the largest M&Es. This offers some leeway for us to marginally improve the corporate tax environment for the corporations that aren't among the largest. This is where the present bill plays an important role. Still, in my view, some aspects merit deeper questioning. First, the amendments to Section 22 propose to limit the favorable tax treatment to 5 years, through to the end of 2028. This sort of built-in deadlines to tax holidays, often referred to as sunset clauses, are now standard fare in public policy surrounding corporate tax incentives. Indeed, even special economic zones, the traditional preserve of tax freedom worldwide, have now begun to routinely incorporate sunset provisions. However, it's crucial that sunset clauses not be prolonged indefinitely, because doing so could give rise to opportunities for politicking and quid pro quo rent seeking, as firms lobby for extensions of special treatment. I will note that in the bill, in clause 2J, it seems to suggest that DEIs have been in place since 2012. It will be useful for this House to understand if there might yet again be an extension of the DEI for qualifying firms, or if the government will indeed commit to adhering to the 2028 date as a genuine sunset. Second, the proposed amendments to Section 41 include, under the definition of fixed capital expenditure in Part 4A2, the, and I quote, acquisition of know-how or patent rights, end quote. While I understand the motivation behind why one might wish to include such expenses as part of fixed capital, the immediate concern is that this could be used as a loophole to creatively transfer existing, intangible assets from one corporate entity to another as a means of reducing taxable income. This sort of potential abuse in transfer pricing was, after all, one of the motivating drivers of the BEPS project to begin with. It would be ironic if our laws inadvertently provided yet another reason for countries to accuse us of seeking a role as a tax haven, albeit on a smaller scale than the M&Es covered by BEPS. Third, I observed that there is a distinctive treatment of the conditions associated with accessing concessionary tax rates when it comes to manufacturing versus services, at least as documented in the existing DEI literature. For example, to qualify for a tax rate of 5% in the former, a firm must expend an additional $13 million in fixed asset investment and employ an additional 30 skilled employees by the fifth year. In contrast, while the equivalent qualifying expenditures for the latter group are the same in the fifth year, it adds further requirements that $8 million be invested and 18 skilled employees be hired by the third year. It will be helpful to understand the justification between this disparate treatment of the two sectors. Mr. Speaker, the end result of this bill will be, I believe, a better lock on the balance of taxation between the ETRs paid by our largest companies relative to our smaller ones. To be clear, the Minister for Finance had, in response to parliamentary questions filed by my honorable friend, Louis Chua, previously stated that the ETR for SMEs over the past decade runs between 4 and 5%, while that for larger corporations amounted to between 10 and 11%. While one may take issue with the precise way that this calculation is made, my sense is that the combination of BEPS-related stipulations embedded in last month's bills, alongside the bill that we are debating today, will go a significant way toward redressing any residual bias in favor of granting large corporations excessively generous tax relief. This is welcome because, as I shared last month, we really should be weaning ourselves off a growth model that is excessively reliant on foreign capitals and M&Es, and moving toward one that is conducive to entrepreneurship and supporting the development of homegrown SMEs as much as possible. After all, M&Es benefit disproportionately more than SMEs from the public goods provided by the taxpayer. Our favorable business environment, safe domestic market for skilled labor, and stable political climate, and have the necessary resources to contribute back towards sustaining the system that they have benefited so much from. We need not fear making these companies pay their fair share, given how their location decisions are driven primarily by the availability of skilled workers, open economic borders, high-quality transportation infrastructure, and a sound institutional environment, and only secondarily by low taxes on corporate income. By the same token, we need to help our small firms who are struggling under the burden of high and rising costs, especially as rising rental costs on land snuff out affordable factory facilities and office spaces. And when the high costs of living are eventually transmitted into durable increases in real wages, these firms will also need to manage their ongoing costs of running their businesses amidst a small, cost-conscious domestic consumer market. Tax relief will give them a genuine shot at growing and perhaps flourishing in the long run. That is an outcome that I'm certain all of us in this House would look forward to seeing. And for this reason, I support the bill.